All right, let's kick things off. We're diving deep today into Deere & Company. We're looking at their recent performance and using their November 21st press release and that earnings call presentation as our guide.
Sounds good.
It's kind of interesting, honestly.
Mm.
We're seeing some declines, right?
Yeah.
But then there are these signs of like resilience and strategic adaptation. What do you think of that?
Yeah, I think that's a great way to summarize it. It's really easy to just focus on those headlines about declining net income. I mean, down, what was it, 47% for the fourth quarter and 30% for the entire fiscal year. But there's more to the story if you look closer.
So what stands out to you when you dig into those numbers a bit?
Well, Deere's still bringing in a significant amount of income. I mean, they pulled in $1.245 billion just in Q4 and a respectable $7.1 billion for the whole year. Now, granted, yeah, those are decreases, they're significant decreases, but we need to put those numbers into context, Like, how do those numbers compare to Deere's past performance? Or how do they compare to their competitors? Are there specific things that are driving this decline? Or is this just a sign of, something going on with the whole industry?
Well, and the press release does mention a drop in both quarterly and annual net sales, worldwide net sales and revenues. What's going on with that?
I think part of it is due to lower shipment volumes across several segments, but it's really important to look at the bigger economic picture. Deere isn't operating in a vacuum. There are global economic headwinds, things like inflation, you've got rising interest rates, supply chain problems, all of that is impacting the entire industry.
Yeah, that's a good point. So how are these economic challenges impacting the different parts of Deere's business? There are different segments. Can you walk us through that?
Sure, let's start with their production and precision agriculture segment. It's, core part of Deere's business. Sales were down 38% for the quarter, mostly due to lower shipment volumes like we were just talking about. And this seems to be a pattern across the entire agriculture industry. It's not just, unique to Deere.
It's interesting though because even with those challenges, Deere's projecting that they're going to have improved operating margins for that segment in fiscal year 2025. I mean, that's kind of counterintuitive, right?
Yeah.
I mean, are they expecting a market rebound? Or are there internal things happening, internal factors?
My guess is it's probably a combination of both. I mean, there are some signs that certain commodity prices they're stabilizing, which could, help farmer income and increase demand for equipment. But Deere is also making changes internally, trying to improve their efficiency and maybe offset some of the negative impacts of those lower sales volumes we were talking about.
Makes sense. Okay, let's look at small agriculture and turf. It seems like a similar story there, too. Sales down 25% for the quarter. And again, it seems like those lower shipment volumes are the main culprit. Is this also tied to these broader economic concerns?
Yes, but it plays out a little differently here. While production and precision ag is really driven by those large-scale farming operations, small ag and turf is way more sensitive to how much consumers are spending. So when the economy slows down and people feel a little less confident about their finances, they tend to put off buying things like lawn tractors or smaller ag equipment.
Yeah, it makes sense. It's like this ripple effect from those larger economic trends. And looking at the numbers, operating profit took a hit in that segment, although Deere did manage to offset some of that decline with price realization. Does that tell us anything about their pricing power even when the market's a bit tough?
It absolutely does. Pricing power is a very valuable asset, especially in these times of economic uncertainty. What it shows is that Deere's brand and their products, they're still in demand, even if, customers are buying less overall. And their ability to keep their pricing up, that could be a big factor in those improved operating margins that they're projecting.
Okay, last segment, construction and forestry. 29% decrease in sales in Q4. Seems to be, kind of mirroring the trend we're seeing in the other segments. Is this more of the same, or are there unique challenges impacting this area?
I think the overall slowdown in the economy is a factor here, for sure. But Deere also specifically mentions headwinds in certain equipment categories within construction and forestry. And they think these headwinds are going to stick around through fiscal year 2025. So that suggests there's something else going on, maybe structural or cyclical issues that go deeper than just the general economic climate.
So how's Deere planning to handle these longer-term challenges in construction and forestry? Are they just battening down the hatches, or are they, adapting and coming up with new strategies?
It seems like they're doing a bit of both, to be honest. They're acknowledging that market conditions are difficult, but they're also making strategic investments. They want to enhance customer productivity, and that could be a really smart long-term strategy.
I see what you're saying. It's interesting how they're adjusting their strategies, for each different segment based on the challenges that each one faces. All right, let's move on to Deere's financial services. Their net income decreased by 9% in the quarter,
Yep.
but they mention higher average portfolio balances and a reduction in derivative valuation adjustments partially offsetting this decline.
Hmm.
Can you kind of unpack those terms for us? What do they mean, and why do they matter?
Sure. So higher average portfolio balances just means that Deere is lending more money, which could lead to more interest income, which is, a positive sign in a tough market. And then derivative valuation adjustments, those are basically changes in the value of certain financial contracts that Deere uses to manage risk. So a reduction in those adjustments, what that means is those contracts are doing better, which is a good thing.
Okay, so it sounds like they're finding ways to kind of make up for those losses and even maybe make some more money within their financial services arm. However, they also talk about a higher provision for credit losses. Is that something to worry about?
It's definitely something we should keep an eye on. A higher provision for credit losses basically means that Deere is putting aside more money to cover potential loan defaults. So that could suggest that they're expecting more borrowers to have trouble, paying back their loans, which ties back into those bigger economic worries we were talking about earlier. It could be a sign of future financial strain, both for Deere and their customers. When we were talking about that higher provision for credit losses, well, that brings up some interesting questions about Deere's customer base and, how financially healthy are they really? It seems like some of them, some borrowers might be having a tough time, probably because of all this economic pressure.
Yeah, it's a good reminder that these financial numbers, these aren't just, numbers on a page. These represent actual people and businesses that are dealing with real problems.
Yeah.
And speaking of problems, well, when you read Deere's forward-looking statements for fiscal year 2025, there's all this, cautious language about economic uncertainty. Like they specifically talk about things like inflation and interest rates and global trade tensions. Seems like they're saying, hey, things could get a little rough.
Yeah, for sure. Deere's definitely not trying to downplay the risks. I mean, just look at their projected net income for FY 2025. They're saying it could be anywhere from $5 billion to $5.5 billion.
Wow, that's a pretty wide range.
Hmm.
So how should we interpret that? I mean, is that a bad sign, or is there reason to be optimistic within that range?
I think it's more about being realistic. They're saying, hey, there might be some headwinds, but they're also saying, look, things could improve if the economy stabilizes or if some of our strategic initiatives start to work.
Right. Right, those strategic initiatives. Deere is making a lot of change. Like there's those employee separation programs, and then they're investing a lot more in technology, and then there's that whole thing with Brazil and the banking scene. What's the deal with those employee separation programs? Those seem pretty big.
They are big. Deere offered both voluntary and involuntary separation packages to um, certain salaried employees in several regions. They're trying to streamline operations and reduce costs,
Yeah.
especially in areas where there's maybe some overlap between roles or functions.
It sounds like a tough decision, but probably a necessary one, right?
Yeah.
Especially with the economy the way it is. Did they say how much these programs are going to cost? Did they give any numbers?
Yeah. They said the pre-tax expenses are probably going to be around $165 million, but they're also thinking that these programs will save them about $220 million per year before taxes once they're fully in place. So there's a cost up front for sure, but in the long run, they're hoping to see some real financial benefits.
Yeah, it's that whole short-term pain for long-term gain thing,
Yeah.
right? Okay, now what about this whole thing with Brazil and banking? What's going on there?
So they've got this subsidiary called Banco John Deere SA, and they're doing this joint venture with a Brazilian bank called Banco Bradesco SA. Seems like a strategic move, to manage risk in an important market. Brazil's got a lot of growth potential for Deere, but there's also a lot of economic and political uncertainty there. So by partnering with a local bank, they're essentially sharing the risk that comes with financing all that equipment, the agricultural and construction and forestry equipment in Brazil.
So it's like they're tapping into local expertise and trying to avoid any potential problems, right? But how did this joint venture affect Deere's financial reporting?
Well, because of the joint venture, Deere had to reclassify Banco John Deere SA as an asset held for sale on their balance sheet. And since they didn't know the final sale price when they were putting together their report, they had to set up what's called a valuation allowance.
A valuation allowance. Can you
Mhm.
explain that for those of us who, aren't accountants?
Sure, a valuation allowance is basically a reserve that companies set aside just in case they have to cover potential losses if they end up selling an asset for less than it's, listed on their books. It's just a way for them to be cautious and make sure those financial statements are accurate, especially when there's risk involved in a sale.
So it's kind of like a safety net in case things don't go as planned, right?
Exactly.
Okay, there's also this other interesting thing, this favorable tax ruling that they got in Brazil.
Right. So the Brazilian Superior Court of Justice made this ruling that basically clarified how certain local incentives are taxed. And that meant Deere could reduce their provision for incur taxes, which boosted their earnings, and gave them some financial breathing room.
Sounds like a good win for Deere given, how tough things are right now. But it also shows just how complicated it can be to do business in different countries with all those different tax laws and regulations.
Oh, absolutely. That's a huge part of running a global business.
Now, let's go back to Deere's internal operations for a second. There was this financial reporting correction related to how they were accounting for certain financing incentives that they give to their dealers. What can you tell us about that?
Well, Deere found a mistake in how they were recording the expense for those financing incentives. They were basically recording the expense too late. So they fixed the mistake, which meant they had to take a one-time charge to their earnings in the second quarter of 2023.
So it sounds like they made a little accounting whoopsie, but they caught it and fixed it quickly.
Yeah, exactly. And it shows how important it is to have those really strong internal controls and good auditing procedures so that your financial reporting is accurate. Mistakes happen, but the important thing is to catch them early and fix them.
Yeah, yeah. That's good advice for any business, big or small.
Yeah.
Okay, we've talked a lot about Deere's finances and the moves they're making and even some accounting stuff, but let's zoom out for a second. What's the big takeaway here? What's this all telling us about Deere's business and, how healthy is it really?
Well, even though they're facing some challenges, Deere is showing that they've got some real strengths. I mean, look, their core operations are still generating a lot of cash flow, and that's a really good sign that the underlying business is solid. And they're making those tough decisions to adjust to this changing economy, like streamlining and managing costs. And they're investing in innovation and technology, which tells me that they're focused on the long game. They want to grow and they want to stay ahead of the curve.
So even though there are some, dark clouds on the horizon, Deere seems to be, well equipped to handle it,
Right.
right?
Yeah, exactly. They're not just sitting back and waiting for the storm to pass.
Mhm.
They're out there, they're navigating it, and they're making strategic choices to make sure they come out of this even stronger.
And some of those choices, those strategic choices, those are really interesting.
Yeah.
Deere's really focused on technology and sustainability and customer relationships. They keep using terms like smart industrial and leap ambitions. Let's dig into those more and see what they mean for Deere's future when we come back for the last part of our deep dive.
All right, so before the break, we were starting to talk about, some of these terms that Deere's using to describe their future. Words like smart industrial and leap ambitions. What do you make of all that?
Well, Deere has such a long history in traditional manufacturing, so I'm really curious to see how they're embracing all these, high-tech concepts. What exactly does smart industrial mean anyway?
Well, it's all about taking those cutting-edge technologies and integrating them into their operations and into the products themselves. We're talking automation, artificial intelligence, the Internet of Things, using all those tools to really change how they design, manufacture, and support their equipment.
So it's not just about building, a better tractor. It's about building a smarter tractor, one that can, gather data and analyze it and even make decisions on its own.
Exactly, yeah. Imagine a whole bunch of self-driving tractors, out in the field optimizing everything, the planting and harvesting, based on real-time data about the soil, the weather, how the crops are doing, or think about predictive maintenance systems that can, tell farmers about potential problems before they even happen, minimize downtime, maximize efficiency, that kind of thing.
It's kind of like something out of a sci-fi movie, but it's actually happening.
Yeah.
And how does Leap Ambitions fit in with all this?
Leap Ambitions is more about Deere's big picture strategy, their vision for the future. They want to be a leader in precision agriculture, sustainable solutions, and those really connected customer experiences.
That that's a pretty ambitious goal. I mean,
Yeah.
can they pull it off? Can a company that's, so deeply rooted in these traditional industries really become this tech-driven powerhouse?
That's a good question, and honestly, it's not going to be easy. The
Yeah.
challenges are definitely real, and there's a lot of competition in the ag tech space these days. But Deere does have some advantages, right? I mean, they've got a strong brand, they really understand the industry, and they're willing to put a lot of money into research and development.
Yeah. And speaking of investments, in their earnings call presentation, they talked a lot about their commitment to R&D and capital expenditures. They even said they might increase R&D spending a little in fiscal year 2025.
Hmm.
That's a big deal, especially now when a lot of companies are cutting back.
Right. It shows that Deere is really serious about innovation. They're making a bet that technology is going to help them get through these challenges and create a more sustainable and profitable future, not just for Deere, but for their customers too.
Okay, so let's talk about sustainability. It's
Hmm.
a hot topic. But how is Deere actually making sustainability part of their strategy?
Well, they know that their customers, especially in agriculture, they're facing pressure to operate more sustainably. So they're coming up with solutions to help farmers reduce their environmental impact, help
Mhm.
them conserve resources and be more efficient.
So it's not just about being green, it's about actually helping their customers,
Yeah.
giving them something real, something tangible.
Exactly. Think about, precision ag technologies that can help farmers use the right amount of fertilizer and pesticides, reduce water usage, minimize soil erosion. All of those things are good for the environment, but they also help farmers get better yields and make more money.
Yeah, it's a win-win, right? But yeah, do well by doing good. So beyond technology and sustainability, Deere's also talking a lot about customer relationships. They use the phrase connected experiences. What does that mean in real life?
It means they're not just, selling equipment anymore. They want to build long-term relationships with their customers, provide ongoing support, insights based on data and personalized solutions. All those things can help customers get the most out of their Deere products.
So it's about building a whole, ecosystem
Yeah.
around their products, not just selling individual machines.
Right. If you want to be competitive today, you got to offer amazing customer experiences. Deere gets that. They're moving from, being product focused to being customer focused because those strong relationships, that's how you succeed in the long run.
Well, we've covered a lot of ground today in our deep dive into Deere and Company. It's clear that they're facing some headwinds, but they're also making these bold moves to adapt and get ready for whatever comes next. They're investing in technology, they're embracing sustainability, and they're really focusing on those relationships with their customers.
Yeah.
It's a strategy that's got a lot of potential, but there are definitely risks too.
It really is a fascinating case study. This is a company that's going through a huge transformation, and the economy is so unpredictable right now. There's no guarantee that Deere's going to succeed, but they're definitely not just standing still. They're out there, they're shaping their own future, and that's what makes them so interesting to watch and to follow.
So the big question is, will it work? Will Deere's transformation be successful? Will they be able to handle the economic challenges and come out on top in the next era of agriculture and construction? I guess we'll just have to wait and see.
That's the great thing about doing these deep dives. We've looked at the facts, we've analyzed the trends, we've talked about the possibilities. Now it's up to our listeners to connect the dots and make up their own minds. What do you think the future holds for Deere and Company? That's something to think about.
And on that note, that's it for our deep dive. Thanks for joining us. Until next time, keep learning, keep exploring, and keep asking those big questions.